Bloomberg Audio Studios. Podcasts, radio, news. And Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix, Paul, Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well, so check us out there. Hey, let's have some fun, kids. Let's talk tax policy. Garrett Watson, Director of Policy Analysis at the Tax Foundation. He's zooming in from Fayetteville, Arkansas. All right, here's one of my lasting images from the early days of the lockdown and COVID. Is the people down in the Ozarks on the lakes partying their brains out. And like none of this social distancing stuff. You can't tell those people not to have a good time in the summer down in the Ozarks. They're out there to have a good time. And that's where our next guest is. Hey, Garrett, talk to us about what's happening down in D.C. I mean, it seems like this SALT tax thing, which is really important in Metro New York. I'm not so sure about Fayetteville, Arkansas, but it's really important for us here. That seems to be a real sticking point, isn't it?
That's right. The leadership in the House is trying to get together the final votes in what is a very narrow margin in that chamber amongst Republicans. And the big sticking point right now is the fate of the state and local tax deduction. Currently, it's capped at $10,000. You can write off your state and local tax payments against your federal taxes. It's been that way since 2018 and expires at the end of the year with the rest of the 2017 tax law. But there's been a lot of intense negotiation about where to put that cap, going anywhere from making the current cap, making it permanent, extending it, or making it more generous, upwards of, we're now hearing a $40,000 cap, maybe putting in income limits. The big sticking point is they haven't come to a compromise design that everyone can agree on that fits with the revenue needs for the rest of the package and the SALT folks can live with to deliver to their constituents back at home.
What do you think realistically winds up getting done, since everyone loves to also hate SALT caps?
So at this point, it seems like it's just a matter of the give and take on the exact numbers here. It seems like there will be definitely an increase in the cap, but a continuation of a cap, be it 30,000 or 40,000 or something north of there. It does look like leadership wants to have some sort of additional income limit that would be new. So if you are a very high earner earning, say, north of $500,000, there may be additional limits that are new there that could also limit the benefit of this expansion. The other thing that's sort of flown under the radar is there is some partial new limits for those folks who are working around the caps using their businesses through pass-through firms. That's been a common tactic, and this bill would partially remove that for certain types of business income. So that's another thing for folks to watch out for if they're planning what this might do for their tax bill in the coming years.
Hey, Garrett, when President Trump was on the campaign trail, he was talking about eliminating the taxes on tips, for example, overtime, that kind of stuff that really works well on a campaign trail. Is that something that can get done in this package?
So there's several I would say trial balloons here that are temporary over the next 4 years that would deliver on a deduction for tipped income, for overtime income. There's a special $4,000 deduction for seniors in here, and even a deduction for car loan interest for those payments for folks who are itemizing and non-itemizing alike. So you don't have to itemize to get it. The big headline there is those are fairly open-ended deductions for most taxpayers who are not very high earners, but they do expire at the end in the next 4 years. And so that will line up with potentially another debate about whether or not those are extended. One way to think about that is we'll have to see if they're popular, right? If people find them helpful. There's of course also the revenue costs. They add up to a few $100 billion over 10. So they would need to figure out how to extend those moving forward. What that means is there may be another tax fight at the end of Trump's term heading into 2029 if it goes forward like that. As
an energy person, I'm obviously really interested in what happens with the tax cuts in the Inflation Reduction Act. What do you think, and then the credit phase outs basically, do you think that those stick where they are right now, or does it get more severe for some of the alternative energy players?
Yeah, for the IRA credits, it's really been a balancing act, both at the committee level and amongst leadership, right, to try to balance the concerns of members who are more sympathetic to those credits amongst Republicans who may have a lot of projects in their districts, worried about the disruption if they're phased out too aggressively, and other folks who are worried about the fiscal cost of these credits and want to see them phased out in a more aggressive timetable. And so right now we're seeing, in the current package, a phase out over the next 5 years through the early 2030s for projects that have not been underway at that point. But there's been a negotiation right now to move that up as soon as 2027. I think that will be the question, is to what extent do folks who are more on the sympathetic side, are they okay with that, right? Will that be too disruptive for projects that are currently being penciled out within their districts? And of course, the other thing looming over the IRA credits, I think that's worth saying, is even if it does pass the House, the Senate may have very different ambitions on this. And that's true of the general package, but specifically with the IRA credits, we may see something very different, much less aggressive in there. But that comes with its own trade-off in terms of the revenue cost. It will bring in $500 billion over 10 years, according to the Joint Committee, and in additional revenue to offset other parts of the tax cuts. So they don't have a lot of wiggle room there, but we'll see if the Senate has different ideas.
Hey, Garrett, I spent my whole career on Wall Street, so I'm all about making money, minimizing taxes. But even I have to admit, the favorable tax treatment that carried interest receives is just extraordinary. Can you give us how that came about, and is there any pressure to change that? Because it's kind of tough to see some of these private equity guys, with effective tax rates in the single digits or the low teens when everybody else is paying 40 to 50%.
Yeah, carried interest has come up time and time again in all these major tax battles. Of course, we had a small change on carried interest treatment in 2017, basically lengthening the amount of time it was required to hold a position to qualify for that carried interest, which is subject to the lower qualified capital gains and dividends rate, upwards of 20 or 23.8%. And there have been efforts to try to tax that income as ordinary income, right? With that, of course, I think two things. One, it isn't a major revenue raiser either way. So if you were to tax it at ordinary rates, it only raises maybe about 20 billion over 10, which is a lot of money, but in the big picture is not a lot when you're talking about trillions. So the major sort of policy debate is on, as you're hinting at, right, the fairness question of what is the appropriate tax treatment of that type of income. On the one hand, if it's just basically like wages, right, like labor income, that would be an argument in favor of taxing at ordinary rates. Folks who are more defensive of the current treatment would say it's more like capital gains income. It's more like investment income, and we don't want to penalize that kind of investment in the U.S. But the big trend, as you mentioned earlier, is it's been an uphill battle to make that treatment stick. We did see the president express some interest in that change earlier, but that's been dropped out of the package, along with other things like raising the top rate on higher earners. These are also issues that could come back up again in the Senate potentially if they're looking at how to make the revenue numbers work.
Yep, sounds super easy, not at all complicated. Garrett, thanks a lot. Garrett Watson, Director of Policy Analysis at the Tax Foundation. We appreciate that in the latest news that it looks like Speaker Mike Johnson has secured an agreement on a $40,000 assault cap increase. We'll, of course, keep you updated on all the latest.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Alix Steele here, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. Karen Manna is Investment Director and Portfolio Manager at Federated Hermes, and she joins us now. Take us out of the blind spot conversation. So when I'm looking at the 30-year yield, 5%, what is the correct term premia for the bond market right now?
Good morning, Alix. Good morning, Paul. Thanks for having me on again. Isn't that really the question of this era, the return of term premium, and what level should we lend at to the U.S. government, particularly in 10s and 30s? I think the answer is far higher and steeper than we had grown accustomed to in the decade after the great financial crisis. So setting that level is what the market is attuned to this week as we swing to the ring of not tariff policy, but move on to extension of current tax policy and how do we get there and get agreement on that. So seems some resistance to directly answer your question around this 5-ish mark. But do the headlines steer us north of there? It's possible.
So, I mean, is it fair to look at a 2-year at 4%, a 30-year at 5%? Nice round numbers, 100 basis points of premium there. Give us just some historic context. Is that a lot? Not a lot?
It's getting steeper, Paul. I typically would look at Fed funds to 10 in my research in evaluating that. And you would usually see that on average over the period, very long period of closer to 150 basis points. We've been teetering around that level and pulling back, but 150 basis points is about fair there, Fed funds to the 10-year. So a little bit of room to go, perhaps, usually that metric. But that's something that we've been talking an awful lot about here at our shop. We do invest and we have a separate allocation or positioning around that yield curve. And we have re-entered a steepener and have been slowly wading into that trade in a diversified way, looking at 2s and 10s and 5s and 30s to try to capture that movement in momentum in the market. Interestingly enough, that steepening had faded around late January and into February, but it seems to be back here with a renewed spirit and perhaps some energy around it. So what we ultimately could see happen is, as the economy slows, and if the data cooperates, again, it's that tension between the hard data published on jobs reports and inflation and all of those sentiment surveys and indicators. They're moving in different directions. One is staying pretty firm or reasonable, while the other shows continued angst. But what we could see ultimately happen is the 2-year goes down, but the 10 and the 30-year don't cooperate, and they continue to either hold near current levels or actually push up slightly higher.
What should the relationship be between your yield thesis and the equity market?
Well, that gets tricky too, and not to always talk my fixed income book, but it's who I am. But I think you do start to struggle with financing growth equities as the 10-year eclipses 475, approaches 5. And if there's any sort of attitude or feel that the 10-year could stay elevated above that 5% mark, I think you could see equities roll over for that financing cost reason. And then folks take a different look at fixed income, more apportioned to the income. Because when your yield exceeds your duration, you do have some protection from volatility around interest rates. So it's bringing that conversation in fixed income back to the income component, but also recognizing that the 10-year is largely the broad strokes base or funding costs for many elements of not just private finance or the public markets that we watch, but also public markets, aka munis.
Credit risk.
Munis.
I know.
Munis.
Let's talk about the muni market,
munis.
because we do love the muni markets. Even though it's not Friday, we'll talk munis. What's the exposure you want to have in the municipal bond market?
Well, of course, that's up to the individual, their financial advisor, their portfolio needs. But if you're need that tax advantaged investing, I would be using it to the full extent that's reasonable within your portfolio construct. Munis here are priced attractively. The credit quality is attractive. It's sound. Nothing is without its risk. And there are definitely corners of the muni market that are more attractive than others. Active managers have peeled back those exposures. They're always assessing credit risk. They're always looking at valuation within the construct of risk and exposure and managing those and trimming and adding as appropriate. But we're very bullish on the muni market right now. Particularly, you had a trade-off because of headline risk surrounding perhaps feeding the budget by eliminating the tax exemption. That has faded somewhat, but created, I think, a real buying opportunity.
All right, Karen, thanks a lot. We really appreciate it. Karen Manna, Investment Director and Portfolio Manager at Federated Hermes.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So I can't believe what just happened.
I know.
I'm sitting in the radio studio, and in walks in Mike McGlone. I didn't think he came up north anyway. Miami Mike McGlone. Yeah, so good to see you.
It's that season, as he kind of follows, like when the snowbirds go home, he feels a need to kind of come back a little bit. I think it's just a little bit of that genetics.
I see. Or they told him to come for a day.
Yes.
Yeah, or that too.
We need you in New York.
Michael McGlone is Bloomberg Intelligence Senior Commodity Strategist. It's so great to see you in person. Bitcoin hitting another record. Is Bitcoin moving like gold as like a protection against what we're seeing in the bond market? Is that what we're seeing right now?
I think that's part of it. Mm-hmm. It's this year it's unique. It's actually following gold, because we know gold made a new high a few months ago, and Bitcoin's catching up today. And all the crypto people say, oh, Bitcoin's going to outperform. But I think the key risk for Bitcoin is, I like to put them in the same category, because they basically are just the ones much more speculative and excessive, like Bitcoin, and the other one's a store of value. But it's that ratio of the ounces of gold per one Bitcoin, about 33 right now. That's the same as 2021. So this rock is outperforming this hot-performing crypto asset, which is I'm a bit concerned about. The key thing is, as I like to point out, Bitcoin will do fine, and it'll do fine versus gold as long as the stock market's going up. And then we proved in Q1 that if the stock market's going down, Bitcoin's one of the first things people sell.
So, all right, let's go to gold here, because I'm going to just front run Alix a little bit here.
Do it.
I mean, I don't like what I'm hearing out of Israel, out of Iran potentially. There could be some more stuff going on over there. I'm surprised oil's not higher.
Yes, well, here's the problem with oil. Last year's low was 65. It's looking up at that level. I mean, it's a bear market.
Yep.
And just the latest data from even, we have excess of supply, increasing inventories. The driving season is just getting started this weekend, yet gasoline demand somewhat declining. The whole picture for crude oil is bad. It needs some kind of supply shock to really get it to go higher.
We're not going to get a supply shock if the dudes in, the basins and they're fracking rock all over the place. The U.S. is putting out a lot of oil.
Exactly. Finally, Paul, you're heading towards the low price cure. We're hearing stories now of the declining potential production from the Permian, which is way, in Alix space. The key thing is it's taking low prices. That's what it typically takes. And the big spike in prices we got to the peak in 2022 just brought on that excess supply. Now we're getting to that scale, but typically you have to get below the U.S. cost of production, which is between $50 and $55 a barrel, to really shut that off and curtail it. That's what we've done for the last 20 years. It's around $40 a barrel. So I stick with that call. And the key thing for crude oil right now is it's the macro, increasing demand and excess supply out of the U.S., decreasing demand from China, and it's the U.S. stock market has to stay buoyant. If we just roll over a little bit, that takes crude oil down to $40.
Which brings me to the question that John Tucker smartly asked. With WTI at 62, but then the energy stocks getting hammered, and I realize it's disproportionate because a lot of that says Phillips 66. I'm wondering why that discrepancy, and if it's just lack of confidence in 62 oil.
Yeah, I think that's what it is. Well, the good news is we're starting to refill the SPR, the Strategic Petroleum Reserve.
So there's some kind of support.
Right?
Yes, so that's support underlying the market.
How does that happen? Who buys and who do they buy from?
Well, that's a better question for people digging in the market closer than I do.
Whoever they want. I mean, it depends on what they need to fill it.
So if I'm the U.S. government, I call up Exxon and say, I want to buy some of your oil that's sitting there in the tanks in Jersey? Okay.
I mean, it just also depends what oil you want.
Okay.
So if you want like heavier oil, which is what a lot of the refiners here use, you can't really call up anyone from the U.S. You're going to have to call overseas operations. That could still be a Chevron or Exxon, but it's the oil needs.
But when you talk about producers, the key thing I look at is the futures curve. And it's very flat. It means these producers have been selling out on the futures curve for years. It's called normal backwardation. And right now it's flat across the curve around 60, which is pretty rare. I think they're hoping for some kind of reason, some kind of spike, so they can sell forward and add to their production. And right now, it's just every time we get these little bounces, you see the curve come back a little bit, you see more selling out in the curve.
So it's May 21st. You're in Miami. Do you notice people going back north?
Sure.
You can get the reservation. Maybe you couldn't get it at the restaurant before.
Yeah, well, as soon as the tulips start popping up in New York, they're out of there. And Easter weekend's a big weekend.
Is that the one? And when do they come down?
Typically by November, Christmas. Typically they're coming down. Yeah, and definitely by December.
And then it's just madhouse.
Yeah, it's madhouse, but I don't really. My wife and I never have a problem getting reservations because we go early. I'm usually I'm early.
Oh, there it is.
I usually in bed by 8 or 9.
Doesn't everybody else in Florida go to bed at?
Well, I guess when they're down there, they stay late. Usually it's a later crowd.
All right, so the Miami still awesome, right?
Well, it's the power of the tax. You can't stop it. Zero tax.
Zero tax. Is it still considered? Are they still trying to attract Bitcoin and crypto? Because we don't talk about that as much as we used to, crypto in general.
There is definitely some of that. That's the key thing we have to rope in today. Bitcoin's made a record high.
Yep.
The thing that I've really noticed is that money goes to places where I don't live.
Right.
I'm more of the, I'm a commoner.
Yep.
But but it's just it's the thing. It's the flow from all wealth is coming there. And the key thing here's a quote like to end with. They say Miami's the money laundering capital of South America. Well, what is New York for the whole world?
Right.
That hurts, Mike. That hurts. Mike McGlone in studio, Bloomberg Intelligence Commodity Strategist, Senior Commodity Strategist.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.